Hi, this is Abdul from the Accounting Way. Uh, Basically, this is a sample model of how does an automated financial reporting model shows up. Basically, this model shows different KPIs, different matrices that are important for any organization to make efficient and effective decisions, to ensure that they are growing sustainably, they are scaling sustainably, and increasing profits. So we have made this on sample data to show how can a e-commerce business in dealing in furniture, or how can a retail business benefit from this. This is all made up data for now. So here we have the revenue number, this profit number, the gross profit margin percentage. The core important thing is the listing of products by revenue. So we can see we have highest revenue from dining table, which is around 125k. When I click on it, we see that we are earning 20%, which is an average margin we are earning. However, we have other products where we have a higher gross profit margin as well. Like for example, in office chairs, we have a 26% margin. However, the revenue is only 16,000. Now, what we can further investigate is how many were the number of units. We can show it on these charts as well. This is a baseline dashboard for now. So and further investigate if we were investing heavily in marketing on dining tables and not on office chair or what. So which led to further revenue, and maybe we could invest some marketing business, or apply some sales techniques which we were applying on dining table also to the office chair, coffee table, bar stool, uh, so that our overall gross profit increases. This percentage increases because once we have more revenue from high GP margin products, the profit is naturally going to increase. That is one way. Second way is, for example, we look at the time series. For example, here we see in July sales were down, in March sales were down. However, in August the sales were up. So what we can investigate or work on is what we did in August and what we did not do in July, or what we did wrong in July or March, or is it seasonal impact? If it is seasonal impact, then maybe it would help us with planning our inventory accordingly. Let's say dining table. In dining table, we had this impact in June as well. So what made it look made what was the reason for this? We can investigate and then maybe correct it, improve it, so that our regular line is above this 15k line, just like we had in August. And we could analyze it product wise. Our sales and marketing team can focus on this. Other than that, we could look at supply chain KPIs. For example, here we have vendor wise defects and lead time. The lower the lead time a vendor has, a better working capital cycle we have with them, and a lower defect rate we have, the lower problems and returns we have from our customers. So for example, here we could straight away see vendor A is relatively better than all of them. So if we are purchasing 28k from vendor A, and let's say we are purchasing 22 or 23,000 from vendor C, and assuming for now, just for now, for simplicity's sake, that they are both able to sell us or provide us with the same items, then we could shift straight away to vendor A instead of vendor C. Of course, there are other factors like credit terms and all, so we can evaluate those separately as well. But for now, based on the lead time and defect rate, we know that vendor C is not that good a vendor. And from this visualization, we could even remove this vendor. We could change the criteria based on our requirement. For example, if I look at vendor A, this thing changes. So the defect rate reduces to 18%, which otherwise on average was 28, 21%. Similarly, we can look at the time series, even vendor wise. And the defects were very high in December. We could investigate the reasons, what we were doing in those lower defect rate months that we were not doing in those high defect rate months. Maybe we could see an improvement. Maybe there was a change in logistics partner. Maybe there was a change in the requirements we raised with our vendors. So we can investigate and then take the right decisions so that this defect rate leakage, this lead time leakage is covered up. Lead time, when the lead time is very high, we lose on the cost of capital side. Here we have the website. Uh, KPIs. For example, which product gave us the best conversion rate, which had the uh, highest card abundant rate, and then maybe we could investigate what is the reason. For example, office chair has a 21% abundant rate, abandonment rate, but coffee table has a higher one. For there's a difference of 5%. So maybe we could investigate that what is the reason for that, and how can we improve it. Even 21% is higher, so we can investigate and improve this. This should directly increase our sales. Maybe we could ask our sales team to call all those people that abandon our cards, ask for the reasons, maybe offer them 2%, 3%, 5%, whatever our gross margin allows, to offer them a discount or something. Then we have this working capital. This is very critical for a new business, for a startup. You should have an eye on your bank balance all the time. One, then you should be able to see how much months are our basically current cash reserves able to cover. This is basically fixed costs covered by our current cash reserves. This is in the case of worst case scenario. Basically, we could have a lot of these similar KPIs on this page. Now this shows we can further borrow 200,000 right now. However, we have listed down our lenders based on percentages, interest rate charges that we have. So Chase Bank has the lowest rate, and we have an available limit of 46k with them. Upgrade has the highest. They have a limit of 25k. Now what we can do is we can maybe evaluate how much do we have we got from Chase Bank, and how much have we got the loan from upgrade. Maybe whatever loan we have taken from upgrade, if it is covered in this available limit, maybe we could we could take that loan and pay upgrade right away. So this should help us save this 8.2%. Instead we would be paying 4.5%, though there would be a saving of around 3.6, 3.7 percentage. So this is basically how it all works. We can add multiple KPIs. We could have further drill down exercises. This is a very basic model, just to show an idea. It can get updated every week, every month, every 15 days, depending on the requirement of the decision takers. Now either we can review these and give the insights to the decision maker. We offer that service as well, or maybe we just update and upgrade the database, the dashboard. We keep updating it, keep improving it, and then the decision makers review it themselves. That could also happen. So that's all from my side on this part. The important thing is we do need good data, good basic data to cover good basic data to cover this up, and that could only be done when we have effective and efficient bookkeeping. So that's it. Thanks a lot. Thank you very much.